The 40-year high inflation rate is worsening homelessness in America. Every $100 increase in median rent is associated with a 9% increase in the estimated homelessness rate. How troubling is that?
Housing affordability. Today we'll be tackling that issue using data from Zillow, Redfin, Realtor.com, and my own sources on how we can potentially move forward. But we can only do that if you first hit the subscribe button and second, watch until the end for the solutions. For many of us, this is the elephant in the room. If this is America after COVID, what was it like before?
Nationwide, we've learned that 2.3 million people lived in homes that were served an eviction filing in 2016. 2.3 million. How big is that number? That's like all the drug arrests that happened that year times 2. Every tragic overdose from the opioid epidemic times 36. It's an enormous problem. So that was incredibly surprising to me.
That's incredibly surprising to me too, Matt. It seems like we're all walking on thin ice after a pandemic with global warming still around.
That's right. When you look at this problem from a sidewalk level, you see moms having to choose between food and rent. You see people put in these tragic, incredibly sad choices. And when you're paying 70, 80% of your income to rent, a very small thing can get you evicted. Eviction is much more the result of inevitability than irresponsibility. You're gonna fall behind something sometime.
While the fear of eviction may not be relevant to you, what about the dream of home ownership?
May was the most expensive month for potential buyers to purchase a home since 2006 due to record home prices and surging mortgage rates.
That's right. The affordability crisis is prompting more buyers to give up on their quest for home ownership.
For many of you buyers out there, you've felt it. Searching for months, competing with other buyers, prices at an all-time high, and mortgage payments significantly higher than just a year ago. Housing affordability impacts us all, and giving up is the only logical outcome.
The Fed has also been aggressively raising interest rates to try and tame inflation, which we've seen an effect on the real estate market. How long before we start seeing positive impact of these policies on the housing and rental market?
The sobering answer is that we just don't know. As you mentioned, the Federal Reserve has laid out a really aggressive set of interest rate hikes that we're already starting to see cool demand in the housing market.
Let me get this straight. Renters, buyers, and now sellers are all negatively affected by housing affordability? Well, to move forward, let's unpack how we got here. Where did inflation come from? Why did prices go so high? And why does it cost so much now for housing? The truth is, they're all connected. Inflation occurs when demand is greater than supply, and that equals higher prices. Higher prices leads to more higher prices, or a spiral known as the wage price spiral, where prices of homes, rent, commodities, goods, groceries all go up. Now, to fix it, either demand or supply needs to change. And if supply can't or won't change for a long time, like new housing, only pushing down demand will fix it in the short term. So the feds are intentionally putting brakes on the economy via higher interest rates to accomplish that. Let's use this first article here as an example to further explain interest rates. October existing home sales. Affordability woes see largest drop in sales in 15 years. The first thing that immediately sticks out to me is in 15 years. That date takes us back close to the 2008 mortgage crisis. So let's make note of that and move on. Demand via volume sold was down from last month and significantly from last year. Supply via total housing was also down from last month and where it was last year. Now for median sales price, they're up year over year. But the important details are actually right below. Existing home sales slipped in October, continuing the trend with every month in 2022 seeing a drop in sales. But the effect was larger than previous months, with October seeing the largest year-over-year existing home sales decrease since 2007, at the same time that mortgage rates hit their 20-year high. Affordability constraints are throwing a wrench into the previous momentum of the market, causing home buyers to step back as they are being priced out. And home sellers are not immune either. Current rates are forcing would-be sellers to stay put in their existing homes with much lower rates, reducing the flow of new listings into the market. Both a pullback in demand and supply are limiting sales counts. Without a significant improvement in affordability, existing home sales will likely continue to disappoint compared to the pandemic peak. Recent downward movement in mortgage rates might provide some reprieve in the coming months, but with home values appearing to hold strong, affordability challenges still remain on top. Great. So it gives context that was missing previously. Demand via volume sold trended down every month this year, with this being the sharpest decline. So an acceleration negatively for demand together with higher interest rates. Let me give you a clear example from my previous video with the link above. If we flip the script of what the typical and the same monthly payments are going to be, that $1.1 million at 3% drops all the way down to $875,000. And where interest rates are today, that drops all the way under $700,000. Higher mortgage rates pushed home prices up significantly in monthly payments. Also, with these rates looking to stay high for some time, the entire housing market has stalled. Buyers can't buy until prices go down. Sellers can't become buyers to move for that same reason and won't sell while prices are going down. We're at this catch-22 due to low home affordability. The Fed publishes robust stats for a lot of important economic data, and this one is the most clear regarding home affordability. The threshold at 100 reflects a neutral ability to afford, with a crossing above meaning it's a positive affordability, while below is a negative affordability. It's clear that we are indeed right where we were running up to the 2008 mortgage crisis. Now, if this trend follows the previous crisis, we're very close to the bottom, and the future looks positive. Now, looking at the drivers behind affordability, we see here the interest rate change is a very significant component of it, and that this time it's much larger than what happened in 2008. It also reflects the impact of interest rates on prices, with both 2008 and now seeing price declines as a result of the rate increase. But the 2008 crisis isn't the same as the one we're facing now, and we'll go over that right after we examine the rental market. Renters need to work 63 hours to pay rent, 6 hours more than before the pandemic. You can see how everything relates. As the price of homes go up, so does the price of rents, but everything comes on its own timeline. Since rental updates only occur once a year, it definitely lags home price increase, as you can tell from home prices topping out earlier this year, while rental prices topping out recently. So this wage price spiral is occurring. And the last domino to drop is actually going to be your wage price increases, and then there are going to be layoffs. Now, the biggest fear going around now is that we're in a recession and home prices will drop significantly. Is that based in reality or fear? Let's take a look at it from this opinion piece for one viewpoint. Opinion: homeowners should prepare for an ugly 2023, but it's unlikely we'll have a repeat of 2008. A much feared correction in U.S. home prices is underway. While this may feel like deja vu, the drivers behind the recent spike in prices and the current housing market downturn are different from the one seen in the 2000s. This time around, the U.S. financial system is better prepared and a national crisis is less likely. I definitely agree with this statement, and the reason being is there was a lot of regulations that came out of 2008, stayed implemented, got loosened a little bit, but especially during COVID, they tightened up even more. So because of these lending standards, you aren't going to have the systemic issue that they have. That'll be explained a little bit further in the article. Now, it's true that the U.S. homeowner should prepare for an ugly 2023. After years of underinvestment and suppressed supply, U.S. home prices rose an eye-popping 45% between January 2020 and June 2022, as low interest rates and the surge in remote work spurred demand. For comparison, in the lead up to the housing downturn that started 16 years ago, prices were up by 30% over a comparable period. What it's effectively saying is prices went higher than it was previously, caused by a few different reasons. One is after 2008, they just didn't build houses. A lot of the home builders got PTSD, and as a result, with less supply and then the surge in demand because of COVID and the reasons that people were looking for homes, you saw a significant increase even higher than that. While housing affordability is at its worst since the last crash and home prices are tracking to continue downward, all is not lost. Cycles exist because human nature exists. Housing affordability before the 2008 crash is close to where it is today, with the future looking bright, not dim like it's been reflecting in the news. They say luck is when preparation meets opportunity, but there's one caveat that may be the most important. and I'll share it in just a moment. If you've been thinking about buying, now might be the time to talk to a realtor and start getting prepared. If you stopped buying, take a second look at why you're doing it, because now might be the opportunity for you to find the perfect home, to negotiate on an amazing price, or to purchase on your own timeline, because all those elements didn't happen or were available the last 2 years. A good realtor will be able to articulate that with evidence and the reason I started the channel. The ball is in your court, and who knows how long that'll last. Now, real estate is very local. You can clearly see it in how different metro areas have changed in prices, with Florida being the majority of the top 10 fastest growing sales prices from Redfin. But the current competitiveness is different, and it's reflected in Realtor.com's hottest markets. This reflects a more up-to-date look at what the current market is now versus its historical change. As a local realtor on Oahu, I do have access to our own stats, so let me pull up the latest that makes the most sense. Now, this chart that answers a question all of you are asking: where is the bottom? If 2008 was any indicator, and potentially the worst crisis we're facing, and similar to what we are facing now, that the bottom was simply a sideways movement for 5 to 6 years, and then it broke past previous highs. Now, if we take the idea from earlier in this video that this downturn is bad, but it's not as bad as 2008, then again, we're much closer to the bottom than you think. If you want a more in-depth Oahu market update, you'll have to subscribe and follow along my Stats Don't Lie series and most recent video both here. Now, what do you think about the housing market? Share your thoughts in the comments below.